Let's get more on this now. Stephen Nash from FIIG Securities in Sydney. Good morning to you, Stephen.
Morning.
Implications of this, essentially, particularly when it comes to institutional investors and their holding of these stocks. What happens?
Look, I think this move by Moody's was fairly widely anticipated. Just looking at spreads this morning, really the demand for major bank paper is unrelenting. Spreads have been moving in for quite a while. That's continuing. I think this move by Moody's indicates, I think, a change within the rating agencies generally. They're becoming more conservative. I mean, this reliance on wholesale funding has been there for quite a while. I think also there may be some moves with regard to exploring more moves with regard to retail funding, maybe more retail bond issues, possibly more focus on the deposit side of the balance sheet. In addition, I think for the New Zealand banks it might be more negative in the sense that they may break out of the AA rating range. A lot of those New Zealand banks are owned by Australian banks, so I think they're probably the main implications so far.
What do they need to do, Stephen, to lessen their reliance on offshore funding? Is there kind of a silver bullet that our banks are missing in this environment, slow to kind of react and adapt, as it were?
Well, I think one of the things we have to do here is probably create a larger bond market. We have to have probably a greater allocation to fixed income. There's got to be I think a plan that moves Australia more towards more reliance on fixed income and less reliance on equity asset allocation. These are issues that have been around for a long time, but really there's been no plan to change that.
Well, that's what I was about to say. Took the words out of my mouth. I mean, I think that's become almost like a broken record for you. But what does it now take? Is it on the agenda? Is it in Wayne Swan's in-tray?
Look, I think apart from the size of the market, there's also the issue about not having a long bond market. I mean, we just don't. It just doesn't exist. We've had a review trying to look at Australia as a possible regional financial centre, and really, how can we do that without we haven't even got a long bond market? A long bond market being bonds in excess of 20 years, large lines of those bonds. Hopefully, I think the way forward would be for the government to get the Commonwealth to issue more in the 20-year sector, possibly then to build up a futures market around that and get the states to move out there. I think investors also need to lengthen their various indices. At the moment, a lot of investors use a 0+ year index. I think that should be moved out to 1 year plus, and that would improve the situation somewhat, but I think even moving them further out would be more beneficial, particularly given that we've got a very high weighting to equities at the moment.
Why would there be a reluctance to move a little further out on the curve like that?
Well, I think with a lot of things in the Australian market, it's just inertia. People are happy with the way things are, and they've just left the benchmarks the way they have been. I think moving out to a 1 year plus benchmark is a really sensible idea. I mean, once a bond becomes less than 1 year, what's the point? I mean, really, it becomes a money market instrument. Yeah.
Right. Let's talk about some revisions from the Reserve Bank. These are quite significant. Assistant Governor Philip Lowe in the last few moments. When you look at the inflation position, forecasts were made just a fortnight ago, and now they're scurrying to play catch-up. Quite an upward revision.
Yeah, well, I think the Reserve Bank, there's the two themes there, as I've been saying for a while. I think the old story of concern about the mining sector and the effect on inflation. I think that's reflected in those revisions. But there's also this emerging story about the consumer. So I think the RBA is developing this story about the more cautious consumer, and I think the question is whether you focus on that as being an emerging issue or something that will fade with a general improvement in economic growth over this year. And I'd say that I think assuming that growth will just wear consumer caution away is probably a bit optimistic, and given the situation we're in, I think this caution will stay around.
That's the thing, isn't it? Because there's also, and I guess he's flagging this, how persistent consumer restraint proves is crucial to the outlook for the economy and in turn monetary policy, because until now, and including now, you know, you've got this restraint on spending, that's triggering retailers that are passing on falls in import prices faster than they would otherwise done. You know, that margin battle, the war for volume.
Yeah, look, we've had you know, a series of problems after the financial crisis, and I think every time we go into these other problems, people you know, revert back to this cautious tone, and I think for that to really fade, we're going to have a period of extended a time where there are no interruptions or there are no further problems, and I think that's pretty optimistic at this stage. For example, the European situation is boiling away. I mean, that could turn nasty at any point in time. You have continued high levels of unemployment in the US. You know, if growth expectations dip there again, that caution will re-emerge.
Well, the Fed was out and kind of spruiking a bit of a rise in its annual growth call up towards the 4% mark now, where it had been sitting around about that 3.5% earlier. But of course, still looking at that labour market as being the weak link.
Yeah, the labour market is a real issue for the Fed. Also, if you look at their inflation forecast, they've maintained those or slightly moderated some of their expectations. I think they can. What the plan would be to get growth going for an extended period to wear down that unemployment rate, and then at some point there will be price pressures. But until unemployment is really worn down, I don't expect there's going to be any issue with inflation. The market seems to be jumping the gun to some extent here.
Well, from that point of view, how did you read the moves in the dollar? Because it was as if they were saying they weren't anticipating any direct withdrawal of stimulus from the Fed.
Yeah, I imagine that the stimulation they have at the moment will be maintained. You know, it's easy to say that they should take away some of the stimulus, but if that was to cause a further recession, you can imagine the criticism to be laid at the Fed. So I think they've got to be very careful here not to interrupt the growth. Growth is starting to emerge and it's great, and we're starting to see that reflected in the equity market, but they have to be very careful here.
Brings to mind that old phrase, green shoots, doesn't it, Stephen? We haven't pulled that out of the bag for a while, but you kind of don't rip those nascent little plants out before they've germinated. Thank you so much.
Thank you very much.
Stephen Nash from